Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, everyone. I'm Zach from Earmark, and thanks for joining us today or watching this on demand. And I want to welcome you to Inside the IPA 500, Key Insights Driving the Profession. And I'm going to hand over this to your instructor for today now, Chelsea. So Chelsea, please take it away.
Thanks so much, Zach. And good day, everybody. Thank you so much for being here. I'm really excited to share with you some of the latest insights from the IPA 500 survey. For those of you who may not be familiar, the IPA 500 is Inside Public Accounting's annual ranking of the 500 largest public accounting firms in the country. We've been tracking these firms for decades, and it gives us a really unique window into how the profession is changing at the top. Now, I want to make something clear up front. This isn't a presentation just about the biggest firms. What happens at the top inevitably shapes the entire profession. Clients and staff and vendors and competitors all look at these big firms to raise their expectations. My goal today is really to reveal what the top firms are doing in terms of growth and profitability and staffing, governance, and then help translate that into practical takeaways that you can use no matter what your firm size is. Think of this as a look inside the playbook of the largest firms with an eye towards what it means for your firm tomorrow. We're going to spend the next 45 minutes walking through numbers and trends and lessons. I'll highlight some areas where the IPA 500 are really pulling ahead and the opportunities where smaller firms may actually have an edge. We're going to save a little bit of time at the end for Q&A or any discussion. The best part of these sessions is hearing what you're experiencing inside of your own firms. But if you have any questions on what I go over throughout the presentation, feel free to ask in the chat, and either myself or Sarah Canning, who's also here today from IPA, will help answer them. So with that, let's get started. I am Chelsea Summers, Executive Director of Inside Public Accounting. I have been working at IPA for over a decade and have tons of experience in the survey analysis, implementation, and I lead the strategic direction of IPA. So Inside Public Accounting, also known as IPA, has been delivering benchmarking reports and data and practice management resources for the accounting profession for more than 35 years. We're known for annual rankings, the IPA 500, which we'll be talking about today, as well as our best of the best firms, and all of the data that we put out. So before we dive into the numbers, let's talk about why this matters and why the IPA 500 isn't just a ranking, but a lens into the future of the profession. We're looking at the growth strategies of these top firms. These firms are showing us what's working in today's market, and then those strategies can help shape the expectations for everybody else. We're also going to look at talent insights, how the firms are hiring and retaining and structuring teams. It really says a lot about where the profession is heading. And since talent is the #1 challenge at a lot of firms, these lessons are very critical. We're also going to explore technology adoption trends, things like AI and automation. Top firms are already experimenting with these tools, and the ripple effects will impact all firms. We're also going to talk about client service evolution. clients are demanding a lot more than just compliance. They want insight, they want guidance and solutions, and that's forcing firms to rethink service models. As we go through today's presentation, really keep this lens in mind. It's not just about what the top firms are doing. It's about how those moves are reshaping the entire profession and what you could take back to your own firms from these lessons. Before we dig into the findings, I want to give you a quick overview of the IPA data. Inside Public Accounting has been serving the accounting profession since 1987. So we have nearly 4 decades of trend lines and data to work with. And that's really part of what makes IPA's data set valuable. It's not just a quick snapshot in time, but really how the profession is evolving. This year in the 2025 survey, we had 605 North American firms who participated. Most of the numbers I'll be sharing today is based on 2024 performance data. The sweet spot for participation in the IPA surveys is firms really with $5 million and above in annual revenue, although we do have some that are a little bit smaller than that. But that's about where the rankings typically begin, and then we scale up to the billion-dollar firms. One thing we're really proud about in our data set is our high repeat rate. About 90% of our firms come back year over year. So we're not capturing new voices. We're really building a consistent picture of these firms over time. And also to ensure data accuracy, we don't just take their submissions at face value. Our team really spends time reaching out to the firms to validate the data and clarify any discrepancies. So when you see the numbers today, you can trust that these numbers are solid and have been vetted. The IPA 500 is not just a ranking that we do, it's a reliable data set that's giving a picture of what's happening in the profession. I want to really look at some trends that are shaping the profession right now. First is private equity. We can't do anything these days without bringing that up, but private equity-backed firms are really not outliers anymore. They are influencing the competitive landscape for all firms. There's opportunities here for those firms, capital for technology, acquisitions, and recruiting, but there's also some risks. There's loss of independence and some cultural shifts inside the firms, and there may be short-term performance pressures. Even if your firm isn't backed by PE, you may really need to start thinking and acting as if you are in order to compete with those firms. Second is AI. This is no longer a future conversation. So many firms are already experimenting with automation and audit and tax. The challenge isn't with, is AI coming? It's really how quickly the firms can pivot from pilots and conversations to meaningful ROI. The winner of these firms will be those who train their people to use the tools and correctly implement the tools and not just buy the software. Third would be offshoring. We're seeing so many more firms open their own facilities or partner with other organizations outside the US, and not just in the India or Philippines, but really exploring many other regions. This offshoring can really help with talent shortages, but it also requires investments into training and making sure there's a cultural alignment inside the firm, and also quality oversight. Also, talent pipeline. Recruiting is one of the top pain points for many firms across the nation. There's compensation pressures that are rising, and firms can't just be throwing money at the problem. The differentiators are going to be things like flexibility and purpose and career development. Firms need to invest in leadership pathways and in their culture in order to keep the best people. Next is advisory service expansion. As client demands are shifting and compliance work isn't always enough, firms are needing to let go of some of their low-value compliance clients and focus more on advisory-first relationships. This shift will help the firm really be positioned for a trusted partner and not just a compliance service advisor. Pricing. We keep hearing about the shift from billable hours to fixed fee or value-based pricing. The truth is, a majority of firms aren't making that shift and are still stuck on the charge hour model. Change is pretty slow, but clients are starting to push for more transparency and predictability. And with all of the changing technologies, I think it's a conversation we're going to need to continue to have. And finally, change management. With all of the things on the list above, PE, AI, outsourcing, talent, firms that thrive are going to be the ones that embrace those changes and instead of really resisting it. Change management isn't just about listing out new processes. It's creating that culture where people are ready and excited to adapt and to grow and to learn new things. This is the overall landscape. It's complex. It's constantly changing. But really, firms that stay static and aren't forward looking and don't have strategic plans in place are the ones that are going to fall behind. So who are these IPA 500 firms? So the IPA 500 represent the 500 largest firms in North America, or in the United States, ranging from 33 billion at the top of the top 100, down to 6 million for the 500. The IPA 100 includes firms over 60 million, the ones that are really driving the consolidation, reshaping markets. The IPA 200 and 300, those firms spanning from 60 million down to 17 million. These are often your fast-growing regionals and strong independent firms. The Forward 500, firms between 17 million and 6.5 million. These are niche players, and they're usually pretty regionally dominant. What matters here is the IPA 500 really gives us a panoramic view of the profession, from the billion-dollar firms to firms that are much smaller, may look similar to your firms. The insights we're going to cover today are relevant across all tiers, but they're also valuable for firms outside of the 500 who want to grow and compete more effectively. So let's start at the top. The largest firms in the country, the IPA 100. These IPA 100 represent firms from 60 million or up to the big four. This year, they reported 147 mergers, which shows you just how much these firms are dependent on acquisitions to grow. This year, turnover improved dramatically. It's down to 10.2% from 14% last year, which I think is a huge signal on how these firms are investing in retention and making it a priority. Another notable figure, 23.5% of ownership is female. It's still not parity, but that number we see continuing to climb every year. It's one of the highest ownership percentages for females in all of our demographic groups. So moving into the IPA 200, the firms that are between 60 and 26 million in revenue. This is a very diverse and dynamic group. Organic growth came in at 7.5%, which is slower than it's been in recent years, but they're still doing very well. Net revenue per partner for these firms averaged about 3 million, so strong productivity at the leadership level. Also, 69% of firms in the IPA 200 are using offshore staff. So this practice is not just among those largest firms, but also we see quite a few in the IPA 200 as well. So our next tier is the IPA 300. These firms range from 26 million to 17 million. These firms are growing at an 8.5% organic clip. So that outpaces some of the larger firms, and that's organic growth without looking at mergers and acquisitions. A big story in this group of firms is the growth of client accounting services and investment advisory services. Both are becoming big contributors to revenue at these firms. For firms that offer a CAD service, it averages about 12% of their total revenue. Profitability is also very strong in this group, with their net income growth averaging 11%. So these firms are doing a very good job of scaling. Now the IPA 400. These are firms between 17 million and 11 million in revenue. This group posted a 9.3% total growth, so including mergers, and nearly a third of their revenue is coming from non-compliance services. Offshore staffing is continuing to rise in this group, and it averages about 8.5% of total staff at the firms who have offshore staff. 42% of the IPA 400 are outsourcing some of their tax preparation work as well. For those that do outsource the work, they're averaging about a little over 300 returns a year. And finally, the IPA 500. Firms ranked number 401 through number 500, and revenues are 10.8 to 6.5 million. This size, even at these smaller size firms, we're still seeing some really strong growth at 7.6% organic, and turnover is improving. It's down to 9.3%. That's lower turnover than all of their larger peers, which shows that there can be some stability and some cultural at these smaller firms. Sometimes they do have those advantages. Another unique metric of the IPA 500 is that they have one of the tightest partner compensation spreads in the rankings. The highest paid partner only makes about twice as much as the lowest paid. And those larger tiers, there's a much wider spread. So these smaller firms are really able to operate with more equity and less disparity. So this chart is really tells a big story of just how dramatically the profession has scaled in the last 3 decades. Back in 1991, when the IPA 100 list first began, only 4 firms had revenues above 100 million. So crossing that $100 million mark was a really big deal. By 2005, we saw the first non-Big Four firm who hit the $1 billion mark. Now in 2025, we have dozens of firms above both thresholds. It's really remarkable how steep the growth curve has become in really just the last 10 years. It reflects the consolidation and specialization and private equity investment, and really a much more business-minded approach to running firms. Setting the stage for today's landscape, one where the scale and the strategy and really the speed of change have reshaped what success looks like in an accounting firm. Firms aren't just getting bigger, although they are, but the pace of growth is accelerating, and the thresholds that once felt like they were impossible to hit is now almost a barrier of entry for the top 100. So I want to go over some KPIs. These are general for all the firms who participated in IPA's practice management survey. So I know we've just been talking about those different tiers of the IPA 500. Most of these metrics are going to look at all of the firms that participated. So this chart is showing total revenue growth. So organic growth plus that growth from any mergers and acquisitions over the past decade. So if we look at the trend, the growth hovered pretty consistently from 6 to 8% for a lot of the 2010s. 2023 and 2022, we saw some major jumps with double-digit growth for the first time in decades. This year, we're starting to see growth slow a little bit, 8.8%, which is still above what we saw for many, many years. So very solid growth, but we're starting to see it trend down slightly. So this slide is looking at revenue per full-time equivalent. So that's our way of measuring the number of people at a firm. So revenue per FTE. So it's how much revenue is generated by each employee. We also compared that to inflation over the past decade. For most of the last decade, the revenue per FTE growth was keeping up with the inflationary growth. Firms were able to grow productively in line with the inflation numbers. So they were maintaining their value per employee. Starting around 2021, we see a gap form. Inflation begins to climb higher than the growth in the revenue per FTE. We're seeing that gap still there, although this time in 2025, for the first time, that gap started to close. So hopefully in the coming years, we can starting to see that gap be completely gone. So this slide is looking at the number of professional staff that work at the accounting firm that do not have a CPA license. So these could be either individuals who are just accounting graduates who are choosing to not go on to get their CPA license. They could be in the process of getting their CPA license. Or these could be non-traditional hires, your data scientist, maybe your lawyer or your healthcare worker who is assisting in specialty practices. So all of these individuals are included in this number. It's a number we're seeing grow year over year. For the past 4 years, we've seen an upward trend, especially in those larger firms. So we also look at technology as a percentage of revenue. There's so much technology and new companies popping up, and firms are investing more and more into the technology that we're using to supplement our practice. So you see some pretty significant growth over the last 10 years where the technology costs, which technology costs are including any personnel in your technology department. So if you have a CTO or you have help desk staff or you have programmers, that would all be included in that revenue number, as well as any hardware costs or any software costs. So all of that is included in that technology number. So over the past 10 years, we've seen the technology costs increase from 3.9% to 5.5% for all of the firms that participate. I'm imagining and I'm hearing that we're going to see those costs continue to rise over the coming years. So something we're looking really closely at. So we also look at net income per partner in our survey. So the amount of profits left over divided by the number of partners, equity partners inside of the firm. So we see a big growth in net income per partner for all of our firms since 2016 over the last 10 years. A number that's continuing to grow. We saw some big leaps that also track with the revenue growth that we saw that was very strong in 21, 22, 23. And we're seeing that number continue to rise every year. So we're also looking at partner age and the managing partner age at the average firm. So the lighter bar on the top is the average age of the managing partners who submit our survey. And then the darker bar towards the bottom is the average age of the equity partner group. So over the last several years, we've seen a downward trend in this number. The average partner group is getting younger, as well as the average managing partner. As more individuals are retiring and being replaced by younger staff, we're seeing that number trickle downward. So we talked about outsourcing and offshoring being a big trend that's going on right now. So we looked and asked, are you offshoring any FTEs and are you outsourcing any tax returns at your firm? And then we also wanted to know, are you planning on doing more of that work, the same number of work, or the same amount of work, or less work in the coming year? So over 90% of our firms are said they're going to have the same amount or more offshoring and outsourcing in the coming years. So that tells us this is a trend that is not slowing down, and we will see ramping up. We also wanted to know, for those firms who aren't doing anything now, are you planning to do so in the future? A little bit smaller of a percentage, but every year we're seeing more and more firms decide that they do want to use outsourcing and offshoring. I want to dig into some numbers for the IPA 100 on private equity and how the firms who have private equity are disrupting the space right now. So private equity backed firms are growing faster. There's 14.5% revenue growth versus 11.1% for all participating firms, or all top 100 firms, I'm sorry. So that's on the revenue side. When you look at the income side, the growth for the PE firms is more than double, 26.7% compared to just 12.1% for everybody else. And the income per partner, there's also a huge gap there, with 1.4 million income per partner for those PE-backed firms, whereas just under $1 million for those non-PE firms. Some of what's driving that is that private equity firms are typically distributing less of their profits to partners. They're retaining about 17% versus just 5% at traditional firms. That money is getting invested into things like technology and infrastructure and talent. So PE firms aren't just chasing top line growth. They're really playing the long game in that. One of the biggest differences we see in those private equity backed firms is their governance models. And that's something that really every firm can learn from and take some notes and some changes back to their firm. Decision making is typically faster and it's more centralized. Instead of waiting for a broad partner consensus, a partner vote, these firms are empowering leadership to move quickly and decisively. They're also bringing in professional management structures. So executives with deep experience in operations or in finance or in strategy. So it's not just partners balancing running the firm on top of all their client work. Partner compensation is directly tied to KPIs. Instead of simply rewarding billable hours or finding new work, compensation is tied to profitability, to efficiency, to firm performances. And that really helps create alignment across the partnership. And finally, there's a stronger sense of accountability across the leadership. Partners are expected to really act like business owners, and if performance lags, there are consequences, often financial consequences. So I think the lesson that all firms can take from this is that you don't have to be private equity backed to benefit from some of these disciplines. The governance practices are what allows firms to execute their strategy faster and more consistently and have greater impact with that. So another difference we see with the private equity backed firms is how they're approaching their staffing and their costs. They're tending to run with smaller and more efficient teams. So instead of adding lots of headcount as the default growth strategy, they're focusing on getting that staff to be more productive and using leverage. They're also making a lot of use of offshore staff, nearly double the rate of non-PE backed firms. And this is giving them access to talent that's at a lower cost and helps scale without overloading domestic teams. If you look at the cost profile on the right, personnel costs are fairly similar, 51.8 for the PE firms compared to 52.9 for non-PE firms. Recruiting costs are a little higher at the private equity backed firms. They're investing more, maybe more upfront to find the right people. But the marketing spend is leaner, 1.8% compared to 2.3% for non-PE firms. The stat I found very interesting was that their technology costs are lower, 5.4% versus 5.7%. Investing in technology more strategically and streamlining current technologies could be some strategies behind that, why that's less. So these firms keeping their teams lean and investing in offshoring and managing their spend, they're able to achieve higher efficiency and stronger margins. And they're not necessarily doing it by outspending. So I think that's a playbook also that all firms can borrow. It's not just about cutting all of your costs, but really being strategic in where you invest and where you stay lean and how you allocate your resources. So some universal lessons for all firms and really all organizations that we can learn from the private equity firms. So apply governance discipline.
Hey, Chelsea, we've got a question in the chat for you.
Sorry, that was so loud. You scared me. Yes.
Oh, was it?
That's okay.
Do you have any stats on employee retention at non-PE versus PE-owned firms?
Oh, that's a great question. And as much as I'm into the data, I do not have it off the top of my head and it's not in my slide deck. But if you'd like to connect with me after, I'm happy to provide you a look at that. Thanks, Brian. Okay, so gosh, that totally threw me off. I don't remember where I was. So I think we talked about applying governance discipline and also focus on the profitability over revenue. So I think too often firms are caught up in chasing their top line growth what really matters is that bottom line growth. So look carefully at your margins, your pricing power, and your efficiency. Also invest into some smarter staffing models. Firms that are pulling ahead are experimenting with offshore, with hybrid, with tech-enabled staffing. So it's not just about having more people, it's having the right mix of people and maybe more of those non-CPA professionals as well. Also modernize and rethink your pricing and technology strategies. Firms that are relying solely on the billable hour model or outdated technology platforms are going to fall behind. So pricing models, automation, and AI are all levers that your firms can start pulling in order to stay competitive. So you don't need to be in the IPA 100 to apply any and all of these lessons. Every firm can take a look at their governance, improve their profitability, rethink their staffing models, and modernize their pricing and technology strategies. So we also looked at specialization firms in the IPA 100. So I know there's a lot of data on this slide, but what we did was we looked at firms who are getting more than 45% of their revenue from either audit and accounting, from tax, or non-compliance services. So including any consulting, CAS services, business valuation, cybersecurity technologies, payroll, anything where they're specialized more than 45% in any of those is our non-compliance category. And then we compared that to all firms to see what it, and kind of give us a control group. So across the 500, we're really seeing that the specialists are outperforming the generalist firms. Non-compliance firms, where they're focusing on advisory and consulting, they grew the fastest at 13.3%. The audit and assurance firms came in really close behind at 12.2%. So there's a strong demand for audit work. When it comes to profitability, the tax-focused firms were the ones with the highest. So if you want to grow faster and be more profitable, doubling down on your specialty is a strategy that works for many firms. You don't necessarily need to be big to implement that, but you need to be focused. So here's some other impacts of these specialized areas. So looking at A&A firms, they grew at 12.2%, which is above 10.4 for all firms. And they also had the lowest turnover of all the rankings or all the groups at 12.4%. So while audit is often seen as a grind, the firms that are specializing here are able to hold on to their people. These tax firms, they're really standing out in their productivity. Tax dominant firms generate $256,000 in revenue per FTE, which is higher than the average in all the other groups. They're also commanding the highest partner bill rates at $684 an average for the equity partners. And they also had the highest income per partner at $1.1 million. So tax may not be the fastest growing service, but it is shown to be the most profitable in terms of our analysis. So the non-compliance firms, those that focus on advisory or consulting, we saw the highest revenue growth at 13.3%, and the highest revenue per partner at nearly $4 million. So when partners at these firms are focused on consulting and on advisory, their leverage and productivity really is able to skyrocket. Across the board, we're seeing that specialization is an edge in these firms, whether it gives them faster growth, a stronger profitability, or the ability to hold on to talent. It's not one size fits all. This is the best formula to use, but the focus is outperforming generalization. So when we look at staffing models across the IPA 500, 3 different themes stood out to me. The first being the average staff to partner ratio. So their leverage number runs between 10 and 16 employees per partner. As you move up in the tiers and the size, the larger firms generally have higher leverage per partner. And this is really allowing the partners to focus more on client work or client relationships and business development instead of having to do more billable hours. The second big trend that we saw was that offshore adoption is really rising sharply, especially in the IPA 100 and 200. You could see on the right-hand side, 83% of firms at the IPA 100 employ offshore staff, and about 2/3 of those firms are outsourcing their tax returns. Even in the top 200, adoption rates are nearly 70%. By the time you get down into the 400 and 500, it's still almost a third of firms. It's no longer just that big firm strategy. It really is becoming more mainstream. And third, looking at the turnover. On the bar chart, most of the turnover inside these firms is voluntary. The rates are highest in the largest firms, 14.6% in the IPA 100, but lowest in the smaller firms. It's telling me that these large firms are still struggling a little bit with retention pressures, although they're easing, and smaller firms may be doing a better job of holding on to their staff. So we're really seeing staffing models shift. Outsourcing is no longer optional. Turnover is still very much employee driven. And that leverage per partner number is continuing to rise in those largest firms. So a couple themes that stood out when looking at compensation and billing rates. So billing rates are scaling very sharply with firm size. In the IPA 100, the average partner billing rate is nearly $600 an hour, that dark blue bar. And in the IPA 500, it's closer to $390. Entry-level staff, the light blue bar on the graph, shows a similar pattern with about $207 an hour in the IPA 500 or IPA 100 versus $139 in the IPA 500. So there is a difference in pricing power, maybe brand strength, and market positioning for these larger firms. So that difference in billing rates is also drives and carries over to partner compensation. A new equity partner in the IPA 100 earns about $840,000 a year, while a new partner in the IPA 500 earns closer to $250,000 a year. On average, equity partners in the IPA 500 are taking home around $482,000. So I think an important point is that it's not just the numbers. It's really what the numbers are telling us about the markets. Billing rates are rising year over year for nearly all firm sizes. But the larger firms have an advantage on their billing rates, and that advantage turns into higher partner compensation. So I think for the smaller firms, don't underestimate your ability to raise your rates. The clients are expecting it. I think the market is still supporting it for now. And without it, I think the gap between the large and the small firms are going to continue to widen. So taking a step back and looking at all the data from the IPA 500, a few lessons are standing out. Specialization can outpace size. So firms that are doubling down on their niche or their specific service area, tax, A&A, advisory, healthcare services, international, these firms are often growing faster and more profitably than larger, more generalist competitors. There's a lot we can learn from private equity-backed firms, but we don't need to copy them wholesale. The key is to take the playbook, read it, and borrow from it selectively. Could be stronger governance, could be tying partner pay to performance, or reinvesting in technology and people. The third is pricing power matters more than hours. The firms that are pulling ahead, some of them are moving away from billing by the hour and towards value-based or fixed fee pricing. I think the shift is not only helping to boost realization rates, but it's also going to help position the business as a partner rather than just a service provider. And finally, offshore and hybrid staffing models are really something that's becoming mainstream. It used to be cutting edge, but now it's really a baseline expectation. Even in smaller firms, they're leveraging their outsourced teams and offshore teams, and they're using that to control costs and to scale their delivery options. So what does all this data mean? What can you do with it? What should your next steps be? Clarify your niche, decide what you want to be known for. In today's market, trying to be everything to everyone is not a strategy for success. Audit your pricing models. Are you still defaulting to hourly billing? Where could you introduce value-based pricing that reflects the outcomes you're trying to give to your clients? Explore offshore and outsourcing options. You don't need to be a large firm to use it effectively. Even small investments can help you free up your local teams to take on higher value work. Also, tighten your governance and partner accountability. Even if there's only a handful of partners at your firm, you can adopt the discipline of setting clear KPIs, measuring that performance, and holding your leaders accountable. That's how you stay agile and profitable in today's environment. So as we're wrapping up, I want to leave you with this. I think the future of the profession isn't going to be about who is the biggest or who is acquiring the most firms. It's going to be who is the smartest and who is the most strategic. I think strategy is going to be scale in the new environment. I think the firms that are going to thrive are the ones that are building with intention. They know where they're going and they're investing in the levers and staying disciplined in where they want to go. I think every firm has some levers to pull. You don't need to be large to act strategically, whether you're specializing, whether you're reimagining or investing. I think these moves you can make at firms of all sizes. So while it's helpful to watch what the big firms are doing, I think we need to ask which of these strategies apply in our firm and which can we add and start doing tomorrow. I want to thank everybody so much for your time today in this. So a lot of the data we went over was in the August IPA Insight, where we highlight the IPA 500. If you want to learn more, the full report is available to order. I think Sarah might put a link to order in the chat, or feel free to reach out. You could dive deeper into the insights we learned when we analyzed the IPA 500 this year and some key takeaways. I'd love to stay connected beyond today's session. You can find me on LinkedIn, where I share insights and updates on the top 500 and what's going on around the accounting profession. We also host the Inside Public Accounting podcast. You can find us on Apple, Spotify, wherever you listen to your podcasts. And we dive deeper into some of the trends that are shaping the accounting profession. You can visit our website, explore the IPA 500 rankings, and then some articles that we publish. Don't hesitate to reach out to me. I'd love to hear your thoughts. If there's data I couldn't cover today and you're interested in, please let me know. I'd love to hear about what's happening in your firms and organizations. And there's my email address if you'd like to send me over an email. Thank you so much today.
Great. Well, thank you so much, Chelsea. I don't see anything live. So for anyone who's attending this live, thank you. And for anyone who's on demand as well, great that you watch this. For those that are here live, here's a quick reminder on how you can earn CPE for having attended today's webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.